All right, good morning, everyone. Chris Hardiman here, and today I have a very special person with me, Michelle Moon with Weimer Group Realty. Good morning,
Aw, thank
Michelle.
you. That's so nice. I
Yeah,
like being a special person.
well, you are. You are. Today we're
So-
here to talk about a really important topic, which is helping a certain segment of the population, right? So older adults, really the baby boomer generation, with housing, but really housing as it pertains to preparing for retirement in those retirement years, how we can help them not only you have helped, are helping so much of that generation with a move within Florida, from outside of Florida into the state. I mean, all over the country. And just tell us a little bit about what you do, how you do it, and we'll take it from there.
Sure. Well, thanks. I really appreciate this opportunity to be here with you, have this conversation about helping people make those later in life moves. I've been serving families for 2 decades now in real estate. And one of my favorite parts is to be able to help people that are putting together those pieces for the later in life moves. What happens? Your more years, and there's a comfort zone. You know where you're going to go in and you're going to put down your mail and where you're going to go and sit and have your coffee in the morning, and that becomes very comfortable. However, sometimes that home becomes too much, or maybe you want to move closer to family, and yet it feels so challenging to figure out how to make those next steps. And my part of the job is to help put all those pieces together, and in doing that, have come up against a challenge over and over again. I can help people figure out where to put their stuff. I can get their house sold for them. I can help them make that move and find the right place. But the biggest piece is the financial piece. And I know I reached out to you recently for this other family, and you were so
We've
great.
had a couple now.
Yeah.
Yeah.
And you were great. This last couple we were talking to, they were trying to move here from up in New York, and they were coming down here, did not have enough funds. They
More New
thought,
Yorkers moving to Florida.
yes.
Yeah.
Yeah, there we go. We have that. But they wanted to move here, and they thought they had planned ahead
Yeah.
enough, because in their mind, they were thinking, well, we'll move south because it'll probably be cheaper living because we won't have that state income tax, those kind of benefits. And the money that they thought they were going to invest in a home was not enough to help them live the lifestyle they were used to.
Yeah.
And they said, my goodness, we don't know if we're going to make that move because we don't have enough to purchase what we want. And you came in with this beautiful solution called HECM. And I really want to know, what the heck is a HECM? Like, where does this acronym come from? What is it? How can you give us some more details?
Sure, absolutely. And the HECM is a scary acronym. It's even scary if you break it out, right? It's a home equity conversion mortgage.
Okay.
But really, very simply put, and we're going to go into greater detail, it's a financial product that gives older adults, ages 62 and older, the ability to do a couple things, right? And really three things, right? They can home and never have a mortgage payment for the rest of their lives. That's one thing.
No mortgage payment.
No mortgage payment for the rest of their lives. One piece of the puzzle.
That's incredible.
That is, yep. They could also create an income stream in their retirement, right? So they could supplement their existing or non-existing retirement income. They could create an income stream, or they could use it to supplement their existing retirement assets to let them continue to grow, leave a larger legacy to their children, to a charity, to a spouse, however it came together. Or you can kind of mix up those three buckets, honestly. So it's a tool that has a lot of different things that can come out of it. And it just kind of depends on getting with the right individual, the right team, you, me, to understand how they deploy it. Typically, a financial advisor gets involved in the picture as well, and we make it work for their situation.
That's incredible. So if I can just back up to what you just said, this is not just to be able to purchase something. This is also, they can create an income out of this.
Yeah. So, I mean, there's really a need for this product, right? So when you look at that demographic. And again, to be eligible for the product, you have to be 62 years or older. I've got the data for 65 years and older, right? So this is the data that exists. The average individual, and by the way, there's 56 million adults in the United States that are 65 years or older right now. Yeah, and you know, this is across the entire country. So would you guess what the average person ages 65 years or older has for retirement savings? You can guess.
Wow. I don't know. I would think maybe 500,000, $1 million.
So they're there, right? But again, we're talking about the average household. And
wow.
that household, 65 years and older, across the United States has average retirement savings of about $200,000, which is not enough. It's not enough to make it all the way.
Not when you're saying you're still at that younger phase of a later in life. So I can understand the financial resistance in somebody to make a move and spend that money, because what are you going to do if you don't have an income anymore?
Correct. So
that's incredible.
So they're there. They have an average $200,000 worth of savings in their retirement account. But in that same breath, this is a generation that has owned the same home for the past 20, 30, a long time. And they've been throwing money at their mortgage. Most of the time, they have a very small remaining balance on their loan or none at all, right? They've been in there long enough to just pay it off, and they've been throwing money at it. So that same segment of the population has $12 trillion worth of equity in their homes that they own. So let's run back through the numbers again. 56 million Americans ages 65 and older.
Okay.
Average $200,000 in their savings, $12 trillion in equity in their home. And I'm not good at mental math. I already did the math before we sat down.
Okay.
But that means that each one of those individuals, just using those numbers, has access to double their retirement savings, an additional $214,000 per household, doubling their retirement savings.
Wow.
The question is, how do you access that? Enter the HECM, the home equity conversion mortgage.
Wow, that's just incredible to me, to be able to double what you have. What a relief. What a relief. I have some questions though when you're talking about this, and I'm sure you're going to probably go into this a little more detail.
Yeah.
But in my mind, I'm wondering, where does this money come from? I mean, it's not like there's a magic genie that shows up and gives you this extra money.
No.
Where does it come from?
So it's a home loan, right? So what it is, and this is a scary term, used to be a scary term, it's a reverse mortgage. And we're going to talk a lot about what a reverse mortgage used to be versus what a reverse mortgage is now, which is a very safe loan product that is insured by the federal government, by the Federal Housing Administration. And the way it works is really all kind of on actuary tables, right? So it looks at older Americans. It looks at when they're purchasing the home, how much equity they have in the home. And based upon all kinds of formulas, we can double or 0.75 their purchasing power, should they choose, and then they never have a mortgage payment for the rest of their lives. We could take a portion of that purchasing power and create an income stream, or we can work with their financial advisor to use it during the down years to basically extend what they have in existing retirement savings so it can continue to grow where their financial advisor has it invested. Wow.
There's a lot of options there.
Yes.
So you did say that word, reverse mortgage, which, as a real estate agent, I've resisted it.
Yeah.
Because to me, that says somebody has to stay in their home, and maybe that home is not the best place for them. Maybe there's stairs and that's not the place for them to age in place. So I have to say, I've had some resistance to that term myself. I know several of the boomers that I have talked to that are planning for their retirement. When they hear something like that, they resist.
Yeah.
However, what I want to go back to is what you just explained, is it's a federally backed loan.
Correct.
With no payment.
Correct.
And so there's no penalty for that. There's no payment. It's similar to like an FHA loan, correct?
It is an FHA loan.
It is an FHA loan. Okay, fantastic. So that answers. I mean,
lot.
we use those all the time.
Correct.
But there's no payment. Now the payment would come due when they move, or if they pass away and their home.
Either one
sold.
of those situations.
Okay.
Right. So if they did decide that they wanted to transition into an assisted living facility at some point, right? Very real. Could happen.
Yes.
Move to Florida, purchase their retirement. Absolutely sell the home. Any remaining equity in the home, just like any other time you sell a home, is their money, right? So it's just loan balance, sell the home, they get the net proceeds from the sale. Where the negative stigma comes into play with the reverse mortgage, just to kind of hit it head on, is there was once upon a time, right, pre-federal legislation that has been passed to correct this, these loans were what were called recourse loans. And what recourse means is that if you end up with those additional funds, that has now been corrected. These loans are now fully non-recourse, which means, let's say you opt to never have a mortgage payment for the rest of your life. And the way the bank did all their math, they thought you were going to live to, 85, whatever. And guess what? Medicine's improving every single day. You live to 100, right? You way outdo the actuary table. And you end up, because you never had a mortgage payment, in a reverse equity position on the home. These are now entirely non-recourse. So say you pass that home to your heirs, to your spouse, and they're just not up for it. They can simply hand the deed to the lender, non-recourse, no trouble, no damage to credit, no additional monies owed, nothing. So that's been corrected. And that was the biggest negative stigma surrounding the product.
Sure.
Now, let's say you do end up passing away earlier than anticipated, and there is equity in the home. The bank doesn't get to claw all that. Like, they don't own your home. It's a similar mortgage, just like any other mortgage. You can, just like any other asset, pass that asset to your estate. They can sell it. To your family.
That's incredible to me, because I am thinking that is totally a legacy piece right there. Because if you're purchasing that home now and you've held on to it 5, 10, 20 years, the equity is surely grown in that. And now you're able to leave more money to your family than that initial amount of money you had for retirement.
Correct.
You've really made a great investment for leaving funds to your family, or securing a future for yourself if you need it. Like you said, if you ended up living longer and needing additional funds, you really have something you could tap into.
Correct. You can have something that you tap into that is established day one that a lender can never take away from you, right? Because the product is fixed.
That's just incredible to me. I mean, I'm not a financial planner. However, I've dealt with plenty that it seems like that return on investment could be bigger than some of the other options that are out there. Actually.
Yeah. And,
I mean, that's
we are definitely going to spend some time talking about another way to use the HECM tool to help grow what your financial planner already has, which is an entirely different topic, but it's worth talking about. But let's talk about purchasing dream homes first, because that's what you do.
Yeah.
You help people
I love helping
buy
people
their dream homes.
Yes. And their dream home, many times at this phase of life, is going to be a home that is more suitable to their current lifestyle.
Yeah.
Maybe they want something that's low maintenance and maybe one story, but they don't want to give up the quality of lifestyle. And that is, to go back to previous conversation about the, folks that have thought that they were going to spend X amount of dollars and then realized to get what they wanted, they needed to spend more.
Yeah. So
You're
I'll
giving
tell you
them
this.
a solution to be able to do that.
You're the realtor. So you tell me, Then let's use that same couple because it's good. It's fresh in our minds. They sold their home for $300,000 in New York.
Yeah.
Right? You tell me what has happened to home values in Central Florida over the past 24 to 36 months.
It's continued to grow. It's incredible. We had such a drive, such a demand for homes that it just made the prices skyrocket.
Yeah.
And, there's concerns. Would you see, those prices go backwards? I will tell you, I've been doing this for 20 plus years now. I have seen lots of fluctuations in our market.
Mm-hmm.
Live there for a while now.
That's correct.
Because they're making a choice move. They're not in a desperation that they have to move.
Nope.
They get to choose where they're living. So they're going to plan ahead and be able to stay there for many years is the hopes and plans. So we're going to see that equity grow.
Yes.
And if that equity grows and they've only made this much investment, but then they've used this additional product to help them buy more, it just seems to me that's going to continue to grow. Am I on the right track here?
Correct. So yes, the asset they invested in will grow. So will their ability to access their growth line, which is something that we're going to talk about for additional income if needed in retirement. But let's just say, like our friends from New York,
yes,
that they don't need the income, that they don't need to supplement the retirement. They just are, two husband and wife that spent their whole careers working as, hardworking, salaried, W-2 employee. They didn't build a business. So they had great salaried incomes their entire working career.
Sure.
But now they're retired, right? So now they have Social Security for sure, maybe a pension, maybe an annuity, but usually not. And they're waiting to start tapping into withdrawing from their retirement assets as long as they possibly can, right? So
there's a gap there, right?
Typically.
Yeah, okay.
But the issue is this. They sold a house for $300,000, right? Mm-hmm. They come down, they call Chris Hardiman or another lender, and they say, hey, I'd like to apply for a mortgage. And I go through their qualified income. And unfortunately, they're no longer making household salaried income of, $180,000, like between the two of them. That's gone now. Now it's just Social Security, maybe annuity, maybe pension, right?
Sure.
Which unfortunately, if you're going in for a standard loan, that's not going to cut it. That's not going to enable you to qualify for the loan you need to purchase your retirement home. It's not. So now they're faced with another situation. They come to you and they say, hey, Chris, hey, Michelle, you linked me up with a lender. All they did was talk to me about a traditional mortgage. I can only borrow $100,000. I've got $300,000 to spend. What can I get? And you're like, well, not any of the things that you're looking at, unfortunately.
Right.
Enter the home equity conversion mortgage, the HECM. So what this does is it will at least 1.75 their purchasing power, right? Typically 2x. So in the instance of our friends from New York, did a little bit better, right? They took that $300,000 from their sale. They put it into a $650,000 purchase. They didn't create an income stream. They didn't do anything to supplement their retirement assets. They just needed to purchase that dream home. And with that $300,000, they purchased their $650,000 dream home with no mortgage payments for the rest of their lives.
Yeah, and they're thrilled. They're absolutely thrilled because they now are just taking the income that they have
Correct.
to pay their utilities, and now they're able to travel because they
Yes.
have that home settled.
Correct.
And that home, by the way, it was a new construction home, brand new, great neighborhood already. The equity, we're seeing it grow already. So they're very happy with this solution, which has been fantastic. That's why I'm so glad we were able to have this conversation. And you were really able to break down what this loan product looks like.
Yeah.
Is there more? Is there more? Is there more solutions here that we could do, that we could use to help some other folks that might be listening to us that are kind of rolling around? Like, I'm trying to plan for my move and maybe I don't want to put all my money into the purchase. I might need some income.
Yes.
What does that look like?
So again, we've got kind of those three buckets, right? Purchase your dream home, create income in retirement, supplement existing retirement assets. And the other piece of the puzzle is creating that income stream, right?
Sure.
So that same example, but we can play with it a little bit differently, right? Say if they just wanted to outright purchase a home, and in that scenario, I was able to get them a $650,000 purchase. Now, say they needed income, right? We could dial that purchase price back, say to a $500,000 purchase, and use the remaining piece there to create an income stream to them for the remaining life of them, basically, right?
Sure.
Yeah. So, we can create a lifetime income stream out of this product, or we can do a lump sum. Sometimes people prefer to make their own investment decisions. So in that instance, you can use your growth line to take a lump sum at a closing, or alternatively, you can create an income stream. But the wonderful thing about the growth line is that it grows with the home appreciates in value.
That's fantastic. You were saying growth line. I didn't understand that. Now I understand that. That's incredible. So what we were just talking about with the change that we continually see in our market over the many years,
Yes.
fluctuations and so forth, but we continue to see homes on a regular basis grow
Correct.
with equity.
Correct.
They're not capped. So if they do have longer than expected life and they want to stay in that home, they can tap into that equity.
Correct.
If there's maybe even they're just starting to run out of some extra funds and they need that extra piece.
Yeah.
Or like you said, they want to pull some money out to do an investment.
Mm-hmm. Yeah, the growth
That's
line component of the
incredible.
HECM always continues to grow with the value of the home, which is a really important part.
Yeah.
Yeah.
I mean, as a real estate agent, I'm thinking that growth line would help. We could help them get an investment property. They could put a couple of renters in and have an income there and then have some other equity go.
Correct. There's a million different ways they can use it, but it's always there and it's available to them.
That's amazing.
Yeah.
Absolutely amazing. My mind is just blown. I'm thinking of some other folks that I probably need to have this conversation with right now.
The couple or the individual that needs to purchase their dream home just can't quite qualify for it. We've talked about the individual couple, whoever it may be, that needs to create income in retirement, but we haven't talked about the third bucket, which is how you can use this product to just kind of turbocharge your existing retirement plan with your financial planner. And I think that's a really important piece of the puzzle.
Tell me more about that. Like if we bring a financial planner in here,
Yeah.
to talk about what our financial goals look like for the rest of our life.
Yeah.
How do you fit into that?
Okay. So I'm going to throw out one very, fancy, complicated word that financial planners love to use. Mortgage guys don't even use it. Financial planners love to use it. And that's called sequence of return risk. And basically what sequence of return risk means is if you just so happen to enter into retirement, right? You just happen to go and start drawing on your retirement assets in a down equities market, right? In a bear
Sure.
market when the S&P, the NASDAQ isn't hitting those average 11% returns. As a matter of fact, they're going the opposite direction. Now your financial planner's entire goal of how long your retirement assets are going to last you, because you're now making withdrawals from your retirement funds when your account is down, right?
Yeah.
So
And
he's
you're just-
selling stocks when you're not getting the gains that he was projecting you're going to get on them. That can make you run out of money and blow up the whole plan that your financial planner put together for you on how long that money is going to last you in retirement. That's called sequence of return risk. What you can do with this product, and I'm not saying time the market. Everybody knows that historically it's impossible to time the market. What you can do is when that market has that declining year, when you are in, say, the year following, and you need your positions, your stocks to rebound, instead of making withdrawals that you had planned on from your retirement funds, you can use this HECM product to pull that same income stream from that product tax-free, so you can give your retirement account time to bounce back with the markets as they inevitably do bounce back. So that's one really cool thing.
That's a real game changer.
It is. If you're moving, no matter what, that's a game changer.
That is a total game changer. You know, with the fluctuations we always see in our market, not meaning just the real estate market, but in our economy as a whole, that just seems to be an incredible resource.
Yeah.
That why don't people know about this?
That's a great question. I think a lot of it has to do with what we spoke about earlier, the negative stigma of the reverse mortgage of old. And the fact that it's just still out there, that stigma. So until we start talking about it, educating really helps.
About this, and
We got to
getting
keep
the word
talking
out
about it.
and getting others to tell their friends.
So we spoke about sequence of return risk, which is the first fancy financial planner word that we threw out there. Now I'm going to talk about the other one, which is exponential growth. And that's another term that really is very important, but financial planners really base a lot of their strategies around this term, exponential growth.
Okay.
And as simply put as possible, it means that when you're investing $1, right, anything, you see the highest return at the latest years of its growth, right, at its invested growth. And the one example that every financial planner uses at every seminar, and they always get a big laugh out of it, and of course it's a trick question, right, is they say, okay, Michelle, if I could give you $2 million today, or I give you 1 penny, but that penny doubles in value every single day for the next 30 days, which option are you going to choose?
Oh, many
And
times.
you know it's a trick question, but
yes, I know, but I could see many times, especially later in life, you'd
Yeah.
say, "Hey, let's just take that big lump sum. Let's go have a great time. Let's, get that legacy started for our family."
Yeah.
I could see that.
Okay. So, I don't have my whiteboard, so
Yes.
I'm not going to walk you through the whole thing, but let me explain quickly what exponential growth means, okay?
Sure.
On day 25, okay, of that penny doubling in value that I gave you, that investment for you now is worth $167,000 about, right?
Yeah.
So day 25, you're wishing that you'd taken that $2 million.
Yeah, because that's a big difference.
Big difference. Do you know what that last 5 days gets you? Do you know what that penny is worth on day 30?
How much?
$5.3 million.
Shazam.
Yeah.
That's a lot.
That's exactly
That's
right.
a big difference.
That's a lot. That's a big difference. Yeah, you could have left $2.3 million on the table.
Wow.
And what this product allows the individual or the family or the husband and wife to do is not leave that $2.3 million on the table. So say you're reaching that exponential growth curve of your invested retirement assets, you can tap into this product to let your retirement assets get those last 5 days of exponential growth to get there.
That's incredible.
Yeah.
Absolutely incredible.
It is. Financial planners love this product. Everyone I sit down with and educate, and none of them know about it, by the way, none of them are aware of this product, look at it, and the conversation basically finishes with, how did I not know this product existed? And again, we're not talking about it. We're not getting out there and we're not educating. So we're going to do more of this.
I'm thrilled to do that. Clearly, this is a game changer. This is totally a game changer for many people who are making those plans for their retirement and figuring out what does it look like. And so many times that can cause despair. You know, you can't see the forest for the trees, what's happening. Well, now we're able to kind of clear that forest a little bit and give a path, which is incredible. That's just absolutely incredible. Like I said, a game changer for many folks. It's really opening up my eyes, even just in planning for my future.
Yeah, you're about to go call your financial planner.
Yeah. How can we plan these things into our future piece here? So this is absolutely wonderful.
Yeah.
I really appreciate you giving me a better perspective on all of this and kind of breaking it down. You know, I hear these terms out there. I see you provide these solutions for families that I'm privileged to serve. And yet really understanding this and its potential is absolutely huge. I can't wait to share this with more people.
100%. I'm right there with you.
So, Chris, this has been so informational. And I really appreciate you breaking down what a HECM loan looks like.
Yeah.
But in my mind, I'm still thinking this sounds a lot like a home equity line of credit.
Another fun acronym, a HELOC.
Yes.
The HECM versus the HELOC.
Yeah. Can you explain what the heck is the difference between the HECM and the HELOC?
Yes.
I mean, really.
Absolutely.
I'm thinking in my mind, so many times we use a HELOC to help people move their financial needle a bit to make
and it's a super
situation
useful
work
tool.
out. Yeah.
It's a super useful tool. We've used it to help families bridge a sale with a purchase. HELOCs absolutely have their place in the world of useful tools that we use when helping people sell, buy, even just leverage equity in their home. This is very different. And I can break it down into 4 buckets why the HECM is so much different than your standard home equity line of credit or HELOC, right?
Yes.
And remember the example that we gave earlier about the couple that had great income during their working years, but now they're retired, right? So income has decreased into a fixed income for retirement place. That's the biggest difference with full doc underwrite. We're not giving them a loan amount based purely upon the income that they can report to us, right? So it's underwritten from an income perspective completely differently than a home equity line of credit, okay? So we
explain that to me, because I'm so used to, a buyer needing to qualify for a loan financially. So
of course.
So how does this look?
Exact same example, right? Remember that when I stated the borrower came from out of state, they had $300,000. They could only qualify for a $50,000 loan on top of that, right? So think about it the same math, okay? They would only qualify for perhaps a $50,000 HELOC, right? Given the same kind of economics, that situation. But using the HECM, they were able to purchase a $650,000 home, right? So back into it, they purchase a $500,000 home. They've got a $150,000 growth line. That, bringing me to my second differentiating factor, grows. HELOCs don't grow. You apply for a HELOC, you get given a HELOC, it's there. It stays there. The home equity conversion mortgage growth line grows every year with the house. So it's easier to qualify for. It grows every single year. First 2 things, okay? Now, home equity lines of credit, many times, particularly during market shifts, you don't use it, you lose it, right? Banks can close those. Banks can close those down if they're not being utilized, and then you no longer have access to it. And everything about retirement is safety and security, right?
Sure.
Safety and security. So to know that you're relying upon a safety net, an emergency tool that could be taken away from you at any minute, what kind of safety net is that, right? So
yeah, it's really crazy to think about. So to break that down, let's say I had a HELOC, a home equity line of credit for $200,000,
and you need it for rainy days.
Yeah, I
right?
wasn't using it, just saving it, just letting it sit there just in case I needed to pull from it.
Mm-hmm.
And the economy shifted a bit. The value of the home shifted a bit.
Or simply the bank's maybe stability shifted.
Or the bank's stability. We've seen that.
Yes.
Unfortunately,
yes. You and I have seen that. Yes.
So they can close that and say that's no longer available to you, Michelle.
Correct.
However, if I had this HECM.
Again, insured by the federal government, that's not getting closed.
And there's that $200,000 that's there because I had that equity there. And
Correct.
so that's what you're calling the growth line. And that could continue to grow if that equity grew. And I had $225,000 worth of equity that could grow to 225 from that 200. Correct?
Yep.
But I don't have to use it, but I could. I could have it just sitting there in case I needed it.
Correct. You can have it sitting there and say you do use it.
Yeah.
Bringing us to our fourth point, payments are optional. You're never going to get optional payments on a home equity line of credit.
No.
You draw on it, you're paying on it.
Sure.
Right? So with the HECM, it continues to grow. It's easier to qualify for. It can't be taken away. And payments, should you choose, are optional.
That's fantastic.
Mm-hmm. I know.
That's really great. So we could choose to make that payment or not. So tell me a little bit about that. What does that payment look like?
Well, it depends, right? It's at the interest rate, right? Okay. Whatever the interest rate is. Because again, you're getting a fixed mortgage when you're getting this product.
Sure.
So it really depends on just any given time, right? Interest rates are crazy high right now. It's not a fun conversation. But just like any other loan, you can refinance this product when the market improves. You can do anything else with it that you want because it is just at the end of the day, an FHA mortgage loan. It's not something funky. It's not something mysterious. It's just a very useful tool that is only available to older adults, ages 62 and older, that they can use to do a lot of stuff.
Wow, that's fantastic. Just knowing they could actually refinance that if they wanted that lower interest rate, they could certainly do it. But because there's no payment due or required, they could actually just let it sit.
Correct.
That's absolutely amazing.
Yep. What other questions can I answer?
What a solution. My brain is just going all over with all the possibilities with this. This is absolutely incredible.
Yeah.
So if their income hasn't changed at all,
correct,
their lifestyle hasn't changed at all, is there a challenge with them thinking about refinancing that? You know, because maybe they're a few years older?
Well, no, because remember, again, as you get older, qualifying becomes easier for the product.
Oh, fantastic.
Because it's all based upon age, actuary tables, kind of like life insurance, quite honestly. But the older you get, the easier it becomes to qualify for the product.
Wow. So if somebody got this at age 65 and now they're getting close to their 70th birthday, but the interest rates have changed and maybe the equity in their home, we would guess has increased. And they wanted to refinance this and maybe start to make some payments just because they're wanting to get, a lower payment on this product.
Yep.
And they refinance it. What you're saying is they would actually qualify for more because they're older?
Again, so, I mean, they're older. I think the biggest differentiating factor there would be that interest rates have changed, right?
Yeah.
So now if they were to refinance this HECM, that mortgage payment, which is, I mean, let's call it what it is. It's a reverse mortgage, completely non-recourse, everyone's safe. But if you refinance into a lower rate, you'd be ticking away at equity at a slower pace, right? So you back to leaving a larger inheritance to your family.
Sure.
There'd be more net proceeds from the sale of that home someday for your children, your charity, whatever you chose.
your spouse. I've seen
Correct.
this situation before where someone had a, this is back in the reverse mortgage days, a reverse mortgage. I remember this doctor, very sweet gentleman. He was setting his wife up for success because he knew he had some, health issues that were going to probably mean that he was going to pass before she did. And he was trying to set her up. So he had her set up with this reverse mortgage. And that got a negative connotation to her family because it was limited and so forth. With this being basically not capped and unlimited in that aspect, this would make a big difference for a situation like that if you were trying to set your spouse up.
Set your spouse up without catching the negative feedback from, your heirs, children, whoever it may be. Because this is in that non-recourse position, you're never going to leave them a liability.
That's I just think there's so many solutions and so many things that this provides that it's incredible.
Yep.
Absolutely an incredible opportunity here. So
we're going to keep talking about it.
This conversation is not over. We're going to continue to talk about this and to bring some more case studies to you as we're helping more families. And what would be the first step for someone to take if they're listening to this now and they are thinking, wow, this could be something. Can I investigate this? Maybe they're only 61, but they know they're going to be 62 here pretty quick. Would that be a good time for them to have a conversation with you?
It's never too early to start planning. It's never too early to start planning. I say this about the home buying process. I say this about planning for anything in your financial world. No, it's absolutely never too early to start planning. And so we can just look at all the pieces. Is going to be so we can back into the income component, the lump sum component. So get with one of us. If you need to start talking about homes, connect with you. If you got a home, you just want to talk about leveraging it as a financial tool to help in retirement, call me up. But you got to start talking to someone, and it's never too soon.
I love what you said there. And that is, some people say, oh, Michelle, she's a real estate agent. I don't want to talk to her because she's going to sell my house. She's going to kick me out. She's going to sell my house and I'm going to be homeless. No, that's never my goal. No. And I love when I have a whole following of people that just stay in touch with me and they call when they have a question. Maybe they have, need some repairs done in their home and they just need a good referral for that. That's great. But I love when I can talk to people that maybe I had the privilege of selling them that home that they're in now. And they're thinking about, where should I go? What should I do in the future? Or, we're getting ready to retire and we want to travel a bit. Yeah. I love that they have that conversation with me ahead of time.
Absolutely.
And this is a great tool to say, let's just sit down and have a few minutes of conversation with Chris and let's plan this out and see if there's something to be had here that can make that difference for you.
Absolutely.
And that's just fantastic. And so let me just ask you another question while we're on that same topic.
Okay.
If somebody were to sit down with you now and have that conversation, again, I think a lot of people feel like I hear this feedback when I say, let me introduce you to my friend Chris, who's with Guaranteed Rate.
The lender.
And they get all nervous saying, oh my gosh, he's going to pull my credit and my credit score is going to plummet and I'm not going to be able to retire and all the things. Can you just dispel that myth for me?
Yeah, 100%. Yeah. I mean, in the current world that we're in today, we can have this entire conversation without even a hard credit inquiry. Okay. That's so great. No damage to credit. No, hey, this is going to impact my ability to retire someday. We can sit down, no hard credit inquiry. We can still really look at we can do soft inquiries these days. They don't damage your credit. They don't do anything to impact your financial well-being. So we can get all the data that we need to have a really fact-based conversation about using this tool in retirement without any damage at all to someone's credit profile, financial well-being, call it what you may.
I love that.
Yeah.
It's those data-driven decisions when you collect enough data.
Yep.
Collect that data and make that decision to make the right steps moving forward. Absolutely incredible. This is opening up so many different avenues for folks. So
I can see it. You're going to get with your financial planner. We're having this conversation.
We totally are.
Okay.
Yes, I mean, it's fantastic. And I'm my mind is open to my own world, and yet so many other people that we can help.
A lot of people
serve.
you can help.
Oh, absolutely
Lots.
incredible.
I know.
So it's such an honor. Thank you so much for having me here
Thank
today.
you.
I appreciate it,
Thank
Chris.
you for coming and chatting.
Thanks. I appreciate it.
All right. Thanks, Michelle.
Bye, Chris.
Bye.